So friends, now we are starting with a new topic, that is input tax credit. Input tax credit, that's it 8. So this input tax credit is one topic which is very important, and upon request of many students I am going little slow with respect to this particular topic. Okay. So first of all, we need to understand how the credit will be availed in the books as well as in the ledger, and what is provisional ITC, what is final ITC, all those things we are going to discuss first. First thing is that there are some steps involved in availing the credit. Step number 1, first we will be recognizing the purchases in our books. Input tax credit will be recognized in our books. So whatever is the purchases, that will be recognized by passing an entry, so that is ITC as per books. Then whatever credit that we take, step number 2, needs to be matched with GSTR 2A and now latest edition 2B. 2A is a return which is based on GSTR 1 filed by the supplier. 2B is also a return which is based on the GSTR 1 filed by the supplier. This GSTR 2A and 2B, so based on that, credit can be availed. So therefore, whatever credit that we are taking in the GSTR 3B needs to be matched with the credit as per GSTR 2A 2B, which means that in first step we have taken the credit, say for example some 4,200 rupees, and 2A 2B the credit reflected is somewhere 2,000 rupees only. Why? Because that person did not file GSTR 1. In that case, how much credit can be taken during the current month? Only 2,000 rupees plus extra 10% we can take. That is 10% of the match credit. That is step 3. Step 3, how much credit can be taken in GSTR 3B? Whatever credit that is reflected in 2A or 2B, okay, plus 10%. Plus 10% can be taken as credit. So eligible ITC as per 2A or 2B, eligible ITC as per 2A or 2B plus 10%, subject to maximum ITC as per books in step 1. For example, if the maximum ITC as per books is say 4,200 and matched ITC is 2,000, so how much can be taken as credit? 2,200. 2,200 can be taken as credit. Suppose if the matched ITC is 4,000 rupees, then how much can be taken as credit? 4,000 plus 10%. 4,000 plus 10%, but subject to maximum 4,200. So 4,200 only can be taken as credit. So 4,400 rupees. So 10% when we add, it comes to 4,400 rupees, but we can take only 4,200 as credit. We cannot take 4,400 as credit. Maximum ITC as per books as per step number 1. Now this is eligible matched ITC. We need to take out the blocked credits and ineligible credits. Blocked credits means what? There are some inward supplies on which you cannot take the credit. Ineligible credits means that the purchases are used for the purpose of making exempted supplies or non-taxable supplies, that is known as ineligible credits. So while taking this matching, we need to take out from the books. Anyhow, we will not take ineligible credit and we will not take blocked credits. Same way in GSTR 2A 2B also you should take out that ineligible credits. So then only you need to do the matching. For example, if the credit that we have availed in the books is 4,200, this 4,200 is after excluding ineligible credit. Ineligible credit or blocked credit. Ineligible credit or blocked credit. That 4,200 rupees is after excluding ineligible credit or blocked credit. Then whatever is the ITC as per books is 4,000. So this 4,000 directly we cannot take. From this 4,000 we need to take out ineligible ITC. So because even ineligible credit gets matched, ineligible credits get matched, and we need to take out blocked credit. Even blocked credit gets matched. So and we need to see. So 4,000 minus ineligible credit and blocked credits if you take out, where in 2A, or 2B if you take out, so that is somewhere 3,000 rupees you get. So that should be compared with 4,200. So therefore we should take 3,000 plus 10% extra we can take. that is 3,300 can be taken. Okay, but actually how much we can maximum take? 4,200 we can take. So 3,300 can be taken. So this is what you need to understand here. So first we need to compare ITC as per books with 2A, 2B. But 2A, 2B after excluding ineligible credit and block credit, because in books definitely we will not take ineligible credit and block the credit. After comparison of these two, only the matched component we can take plus 10%. So on that matched component 10%. Literally what is the provisional ITC that we are taking? This 10% is what we are taking, extra. So beyond that we cannot take anything extra. And this 10% also eventually should be matched by the time we file the annual return. That is step 4. So whatever credit that we have taken in GSTR 3B needs to be matched with ITC as per GSTR 2A and 2B eventually by the time we file the annual return, which means that so this 10% whatever we are taking extra, why we are not taking, like not getting matched? Because supplier did not file GSTR 1 or reported wrong information in GSTR 1. Supplier will again report it correctly at a later point of time. As and when supplier reports it correctly at a later point of time, the recipient can take the credit. But sir, how it will be reflected? Say this man, GSTR 1, he reported instead of 1000 rupees, he reported it as 800. So again that 200 rupees he will report it properly in the next month. How we will know? So in 2A, not in 2B. 2B is a static return, whereas 2A is a dynamic return. So 2B, only that month data will come. But in 2A, even any rectifications which is made by the supplier in their returns through amendments, that will be notified to us in 2A. So therefore in 2A that information will be there. 1 month he need to pay 1000, like 1 month 1000 rupees should be declared as value. He declared it as 800, and in the other month he is now rectifying. So when he rectifies, now the rectified information will come in 2A. Based on that we can match it eventually. So eventually it gets matched. Okay. So this is what we need to do. And annual reconciliation. So again at the end of the year, before filing annual return, so we need to do this comparison with 2A, 2B and GSTR 3B. So then it should be matched. Okay. Suppose if we have taken any excess ITC, so that excess ITC availed should be reversed. The excess ITC availed should be reversed along with interest at the rate of 18% per annum. Suppose if there is, not excess availment, no excess availment, means we availed less. Okay, fine, matched. We availed less, matched, and we availed which is equal to TA to B, that is also matched, leave it. So provisional ITC equals to final ITC if ITC availed in 3B matches with ITC as per 2A 2B. Sir, if ITC availed in 3B is less than ITC as per 2A 2B, that is also okay, fine. Only thing is that you should not have taken more credit. So these are the 6 steps through which we will be taking the credit here. Okay. Then so this is the way in which ITC will be availed right now. So there is no other go. Now here you need to understand what is the difference between 2A and 2B. So because 2B is a latest amendment applicable for May 21 exam, so you must be knowing what is 2B. 2A is a dynamic document based on invoice uploaded by the supplier. So as and when GSTR 1 changes, as and when GSTR 1 of the prior period changes, 2A will automatically change. But 2B remains static and do not change based on the future actions of the supplier. Source of 2A. From where 2A will take the data? 2A will take the data from GSTR 1, that is outward supplies return which is filed by the supplier. GSTR 5. So a return which is filed by this non-resident taxable person, NRTP. So that, and then GSTR 6. A return which is to be filed by an input service distributor. So based on that ISD return, so input service distributor will take the credit and will distribute the credit. So input service distributor is typically a head office or a corporate office which will be taking the credit, and they will be distributing the credit to their branches. So the branches can take the credit based on the invoices given by the input service distributor. So that will also be reflected in GSTR 2A. And 7 and 8 is TDS and TCS. TDS and TCS information also will be reflected in 2A. Whereas the source of 2B is GSTR 1, no doubt, 5, no doubt, 6, no doubt. but 7 and 8 information will not be there in 2B. TDS, TCS information will not be there, and information from ICE gate, that is imports ka data will be there. On imports we pay IGST. That IGST data will not be there in 2A, but it will be there in 2B. Now, 2A does not contain IGST on import, but 2B contains the data obtained from customs server. Sir, at the end of the year, 2A and 2B will always match, sir. No, definitely it will not match. 2A and 2B never will match, because 2A and 2B, so first of all, the source will differ. So 2A, whatever is the source, the same source, 2B is not there. So it may or may not match. That is irrelevant. What we need to see is that 2A or 2B, 2A or 2B versus 3B. So that is what we need to check. So here we are not comparing 2A, 2B. So 2A, 2B we are not comparing. 2A is also one source, 2B is also one source, and we need to take. And sir, which we need to take for the current month? For the current month, take 2B. For the current month, take 2B. And suppose if any previous month adjustments are there, that will be there in 2A, so take that. For current month, take 2B data, and any previous month, prior months, etc., anything, if the rectification is done, so 2A also you check. So in a particular month, if you take 2A and 2B data, if there is any difference, what does it mean? It means that supplier has rectified. When supplier has rectified GSTR1, that will not come in 2B, that will come in 2A. So this is the difference between 2A and 2B. Okay. So this can be asked as a important short note question about what is the difference between GSTR2A and GSTR2B. Okay. They can ask. Now, sir, I have a doubt, sir. So apart from this matched credit, is there any way that I can take the credit? 10% I can take, 10% extra I can take, and furthermore, IGST paid on imports is now available in 2B. Correct? Now available in 2B. Now available in 2B. Now available in 2B. So there is no problem. So we can take that credit happily. Whereas GST paid under RCM, that will not be there in anywhere. So that can be taken as credit. So matching is not required. Whatever GST that we have paid under RCM, we can take it as credit, and for that matching is not required. So therefore, right now matching is not required only in two cases. Only in two cases matching is not required. That is GST paid under RCM other than IGST paid on import of goods, because IGST paid on import of goods is now available in 2B, and whatever GST that is paid under RCM, or number 2, 10% of the matched credit. These two can be taken even though there is no matching on a monthly basis. Okay. So therefore this is about the exception to that matching. And then here I have given the information about various returns, whatever we have come across. GSTR1 is a return of the outward supply. So every supplier will be reporting outward supplies B2B, and based on that only GST portal will generate GSTR2A and 2B and will make available to the recipient. So then GSTR3B is a consolidated return which is to be filed by every person. Electronic credit ledger, whatever credit that we take in GSTR3B, how much ever credit that you enter in GSTR3B, that will come into electronic credit ledger. Electronic credit ledger, whatever is the balance, can be used for payment of only taxes, cannot be used for payment of any other liability. GSTR9 is an annual return which is to be filed by every person by 31st December of the succeeding financial year, and if there is any unmatched credit at the time of filing annual return, that needs to be reversed along with interest. Okay, so this is about the concept of matching of credit and availment of credit. And anywhere if you come across this, you just give a reference of rule 36 sub rule 4. As per rule 36 sub rule 4 only you can take this credit. So this step 2 information is given in rule 36 sub rule 4. Rule 36 sub rule 4, matched credited plus 10% can be availed as ITC. So with this we completed the matching concept. Now we are looking into the next area, manner of utilization of credit. See, this manner of utilization of credit is not given anywhere related to input tax credit sections, but given in section 49 subsection 5. And that is, once we take the credit, that credit can be used for what purpose? So there are few principles which we need to remember. Principle number 1. So there is no restriction with respect to IGST. What does it mean? Which means that IGST credit can be used for payment of any GST liability and any GST credit can be used for payment of IGST liability. Whereas the remaining credit CGST, SGST, UTGST, so cross utilization is not possible, so it will be adjusted only with the respective liabilities. So simply remember that IGST is like a person, a male, and CGST is like wife of that person, and SGST, UTGST is like parents of that person. Wife will never adjust with that boy's parents, correct or not? Same way boy's parents will not adjust with that son's wife. So therefore, CGST cannot be adjusted against SGST, UTGST, or SGST, UTGST cannot be adjusted against CGST, but with IGST it can be adjusted. Okay, that is principle number 1. And principle number 2, so once we have the IGST as a credit, that should be first used for payment of IGST liability, and still if there is any balance, that can be used for payment of CGST, SGST and UTGST. So which means, should there be any order, there is no order, I can use it in any manner. So therefore I can use completely for CGST, then I can use it for SGST, or I can equally divide it, or I can divide between any ratio, it's up to me. So therefore I will be doing a tax planning, and whichever is feasible for me, where my cash outflow will be coming down, I will go for that particular option in this case. So IGST credit, first for IGST liability, then for CGST, SGST or UTGST, but the remaining 3, CGST, SGST and UTGST, first it should be used for payment of its respective liabilities, and then if there is any balance, that can be used for payment of IGST. This is the second principle. And next, third principle, before utilizing CGST and SGST credit, ensure that the credit of IGST is completely exhausted. So IGST credit is fully spent, then only you are using CGST and SGST credit. So therefore, this IGST credit, when we are exhausting, first we will be using it for payment of IGST, then between CGST, SGST, and then only touch CGST, SGST credit. Because if at all there is any carry forward credit, the carry forward credit should be CGST, SGST credit, but not IGST credit. That is the intention. Then principle 4. Principle 4 is applicable in a situation where I have multiple credits, but only one liability called as IGST liability. For payment of IGST liability, first I should use IGST credit, then CGST credit, then SGST or UTGST credit. These are the 4 principles which we need to follow, and these principles are given in section 49 subsection 5, 49A, etc. and all. So just remember that section 49, which deals with the manner of utilization of credit. And sir, when I have multiple liabilities, but the credit is IGST credit, I can use it first for IGST liability. In what manner I need to use depends. So therefore alternative answers exist in that particular ratio. So IGST credit after utilizing for payment of IGST liability can be used for payment of CGST and SGST liability in any proportion. So multiple answers possible in the exam. You please be careful. My view is that depending upon CGST and SGST liability, it should be apportioned so that the cash outflow gets minimized. Then, so these are the basic aspects related to input tax credit. First of all, what is input tax credit? Input tax credit means GST paid on inward supply. On our purchases, whatever GST that we have paid, that is known as input tax credit. GST paid on inward supply is known as input tax credit. What we can do with that? We can use it for payment of GST on our outward supplies. Okay, this is simply the concept of input tax credit. So GST paid on inward supply can be taken as credit and adjusted against the GST payable on outward supply. In that, we are now discussing, so far what we have seen is the background related to that. Now we are discussing the law part, legal part related to input tax credit. That is total 5 sections that we have. Section 16 deals with conditions for availment of ITC, 17 deals with apportionment of credit and blocked credit, section 18 deals with input tax credit in special cases, section 19 deals with job work, section 20 deals with input service distributor, and one more section 21 is there, that is also connected to input service distributor. So section 20 and 21 related to input service distributor concept. So these 5 concepts or 6 subsections which we need to remember. In that we are starting with the first one, that is section 16. So section 16 to 21 deals with the provisions related to input tax credit. Apart from that, rules also are applicable. But rather than remembering the rule numbers, if it is very, very important rule number, you try to remember that rule number. But section numbers, please give good importance to the section numbers. So section 16, conditions for availment of ITC. Total 6 conditions are there for the purpose of availment of ITC. Number 1, only a registered person can avail ITC. Unregistered person cannot avail ITC. And the inward supplies on which they wanted to avail ITC should be used or intended to be used in the course or furtherance of business. So used or intended to be used, it may not be used now, it may be used in future, but then also they can take credit now. In the course or furtherance of business, in the course means for their existing business, furtherance means for some business which they are going to start in future. So only a registered person can avail ITC, and it should be used or intended to be used in the course or furtherance of business. Number 3, it should be the person who wanted to take ITC should be in possession of the tax paid document. Whatever is the tax paid document, that is a tax invoice. There are total 5 tax paid documents. So 5 tax paid documents, tax invoice is there, debit note is there, and then bill of entry is there, then input service distributor invoice is there, and invoice can be given by supplier to recipient or recipient to supplier. Okay, 2 invoices already which we have seen. So total 5 documents, invoice by supplier to recipient on the basis of which recipient can take ITC, invoice given by recipient to supplier on the basis of which recipient can take ITC, debit note, whenever there is an increase in the invoice value, supplier will be giving a debit note to the recipient. On the basis of the debit note, recipient can take ITC, and bill of entry is filed at the time of imports. So whenever we do imports, at the time we file a bill of entry with the customs. In that IGST is there, so therefore bill of entry is a duty tax paid document on the basis of which credit can be availed. And then ISD invoice, I told you already, there is a head office which will be distributing the credit, and whatever credit that they have distributed, we can take it as ITC, that is ISD invoice. These are the 5 tax paid documents. So the person should be in possession of the tax paid document. The person should be in possession of the tax paid document. So what are the various tax paid documents? Invoice given by supplier to recipient. Invoice given by supplier to recipient. One second. So tax paid documents. So what are the various tax paid documents? Tax paid documents. So the various tax paid documents are: number 1, invoice by supplier to recipient. Invoice by supplier to recipient. Invoice by supplier to recipient. Number 2, the second document is like invoice by recipient to supplier. Invoice by recipient to supplier. Invoice by recipient to supplier. Number 3, debit note. Debit note. Number 4, ISD invoice. ISD invoice. And then bill of entry. So these are the tax paid documents which should be in possession. Sir, I have got an invoice. I took the credit, but that invoice is not with me, so I cannot take the credit. If I have taken the credit also, that credit needs to be reversed. Okay, which means that, so here it is not about the documents, it is about the possession which is important. So I should be holding the documents. So whenever they come for audit, and I should be submitting all those invoices on the basis of which I have taken the credit. Then condition number 4, should have actually received goods or services. Say invoice is in the month of July, but the goods are received in August. I should take credit in July or August. I can take credit only in the month of August. I cannot take credit in the month of July. And should have actually received goods or services, both. So services also should be received. So therefore, in case of services, on advances we will be paying GST. And can we take credit? No, they cannot take credit, because on advances supplier will definitely pay GST and he may charge it to us. Now on that, can we take credit? No, till the time we receive the services we cannot take the credit, even though we have got the invoice. So we need to wait till the time the services are received. So which means that definitely to that extent they need to defer the availment of ITC. Now in this case, sir, supplier will be reporting already that transaction in their GSTR1, but the recipient will not be able to take the credit in that particular month, will be taken in a later point of time. Yes, so that is what I was referring to. It will not come in 2B of the month in which they are taking credit. So based on the 2A of the previous month, so they can take the credit. But yes, they can take the credit with respect to this. Should have actually received the goods or services, and there is a concept of deemed delivery in this place. What is the deemed delivery? Say in case of bill to ship to transactions, goods are delivered to some other address and bill is given to another address. So now the billing address will take the credit. So here there is a concept of deemed delivery. The day when shipping address has received the goods is deemed to be the date on which billing address also have received the goods. For example, A Limited, which is located in Hyderabad, Telangana, placed an order with me to deliver goods to B Limited, their client, who is located in Chennai, Tamil Nadu. Now I delivered the goods to Chennai, Tamil Nadu. I raised the invoice to Hyderabad, Telangana. Now Hyderabad, Telangana can take the credit the day when, so their client has received the goods in Chennai, Tamil Nadu. On that day they can take the credit because it is deemed that they have received the goods. Is it applicable only in case of goods? No, it is applicable even for services. For example, no one holding company asked me to render services to their subsidiary company. I rendered services to the subsidiary company and I raised invoice to the holding company. Now holding company can take the credit, of course, because the invoice is in the name of the holding company, and the day when subsidiary company has received the services is deemed to be the date on which holding company has received the services. So therefore this deemed delivery concept is applicable in case of both goods and services here. And next one, supplier should have paid the tax with respect to such supply. So that is, whenever we are making payment to the supplier or not, that is irrelevant, but the supplier should have paid the tax. How do we know whether supplier has paid tax or not? That's what we will see in GSTR 2A. So whenever 2A or 2B the transaction is reflected, it is deemed that the supplier has reported it in GSTR 1 and he will be paying it. So we can take the credit happily based on 2A and 2B. If the supplier is not reporting in GSTR 1, we cannot take credit. So that is the logic here. Should have filed the returns. So because the credit cannot be taken without filing returns, so we need to file a GSTR 3B, only then we can take the credit. Directly we cannot go into the electronic credit ledger and pass the entries. That is impossible. Okay. These are the 6 conditions should be satisfied for the purpose of availment of ITC, which is given in 16 subsection 2. So I am just quickly repeating these 6 conditions. Number 1. So only a registered person can avail ITC, should be in possession of tax paid document, should be using it in the used or intended to be used in the course or furtherance of business, should have actually received the goods or services, and supplier should have paid the taxes and should have filed the returns. These are the 6 conditions. Upon satisfying these 6 conditions, ITC can be availed. If any condition is not satisfied, whatever the credit that has been availed, first you should not avail. If the credit is already availed, that needs to be reversed. Reversal is simple, just like in 3B how we will take credit. There is a line for reversal. In that reversal, if you mention, automatically the balance will come down. If I don't have balance in that particular month, so then whatever I mentioned as reversal will be added to my liability and I have to pay that. If I have a balance, for example, 1 lakh is the balance, 20,000 is the reversal. That 20,000 when I mention as reversal, from 1 lakh it gets adjusted, only 80,000 will go to the ledger. If I don't have any balance in the credit, if I am not taking any credit during that particular month, then ITC availed will be 0, but ITC reverse will be 20,000. This 20,000 will be added to the liability of that particular month and I need to pay by cash that 20,000 rupees. Okay, so this is what I need to do. Then what is the meaning of input tax? Input tax means GST paid on inward supply. It can be all GST, CGST, SGST, UT GST, IGST, everything. Even tax paid under RCM also can be availed as credit. So tax paid under RCM should be availed as credit in the same month or in the next month. It can be availed as credit in the same month. Means same month we are taking, same month we are adjusting, then we can ignore none. No, because whatever GST that we paid under RCM, should be paid only using electronic cash ledger, but I cannot use credit ledger. For example, I have 1 lakh rupees of credit balance. Now I have to pay some GST under RCM 15,000. Now for payment of 15,000, I cannot use 1 lakh rupees. I have to pay 15,000 separately using cash ledger, and that 15,000 can be taken as credit. Now what will be my revised credit balance? 1 lakh already plus this 15,000 what I pay, 1 lakh 15,000 will be my revised credit balance. So whatever GST that is paid under RCM should be paid using electronic cash ledger but not credit ledger. But whatever is paid will be added to the electronic credit ledger. What we can do with that? we can use it for payment of some other liability. Whenever the liability arises, forward charge mechanism, whenever liability arises, for that we can use this balance. And composite tax cannot be availed as ITC. Composite tax refers to tax paid under composition scheme. First of all, a person who is opting for composition scheme will be paying tax to the government at a concessional rate, but with a condition that they should not be collecting GST from the customer. Suppose if they collect GST from the customer called as composite tax, can the customer avail that as ITC? No, composite tax cannot be availed as ITC because it is specifically excluded. Please see, input tax definition excludes composite tax. Okay. Then, so whenever we refer to invoice, what are the minimum contents that should be there in a document to be called as an invoice? That is also prescribed. So there are a lot of invoices, but any piece of paper will be called as an invoice if it contains certain basic details. What are those details that it should contain? It should contain, first, what is the amount of tax. So basically, logically, you can understand GSTN of the supplier should be there, GSTN of the recipient should be there, description of goods or service should be there, and what should be the value and what is the tax. These are the 5 important things: GSTN of supplier, GSTN of the recipient, description of the goods or services, value, and the tax. Apart from that, extra what we need to have is the place of supply if it is an interstate supply. So these are the 6 details that should be there in a document, and then that piece of paper will also be called as an invoice, on the basis of which we can take the credit. But generally when you go to a supermarket, you will be getting a small paper, a slip, and that slip will also be called as invoice, provided in that slip if recipient GSTN is mentioned. And then inward supplies means what? Inward supplies are categorized into 3: inputs, input services, and capital goods. Capital goods definition is very simple: any goods which are purchased by a person and capitalized in his books is known as capital goods, whereas other goods will be known as inputs, and input services means any service received. But these inputs, input service, and capital goods should be used or intended to be used in the course or furtherance of business. So then this deemed delivery already I have discussed with you, and deemed delivery is what? In case when the goods or services are supplied to some other person and invoice is raised to another person, the person to whom the invoice is raised can avail the ITC, and it will be taken as the date on which that person, that is the shipping address, has received the goods or services, should be deemed as the date on which billing address has received the goods or services. In case of goods received in lots or in installments, say against a particular invoice the goods are being dispatched in lots or in installments, and that comes at a different points of time. We have a condition that goods should be received, only then we can take the ITC. So can we take proportionate ITC here? No, we cannot take proportionate ITC. Till the time of receipt of the last lot we need to wait, and only upon receipt of last lot we can take the ITC. ITC shall be availed only on receipt of last lot. Then there is something called as supplier. To the supplier, there is nowhere in the 6 points conditions that recipient should make payment to the supplier, only then recipient avail the ITC. No. So which means that recipient will avail the ITC even if recipient is not making payment to supplier. But there is a condition that recipient should make payment to the supplier within 180 days from the date of invoice. Otherwise, so much of the credit which the recipient has taken needs to be reversed along with interest at the rate of 18% per annum from the date of availment till the date of reversal. Again I am repeating. So recipient should make payment to the supplier when? Within 180 days from the date of invoice. What will happen if the payment is not made within 180 days? Recipient already would have taken the credit, that credit needs to be reversed. And only just reversal? No, not only reversal, along with interest also he need to pay. And what will be the rate of interest? 18% per annum. In GST we have always, wherever interest payable, 18% per annum. In customs, remember it is 15% per annum. In GST it is 18% per annum, in customs it is 15% per annum whenever we are making payment of interest. So we need to pay interest at the rate of 18% per annum from the first date from the date of availment of ITC. So whenever we take the credit, when we would have taken credit, whenever we file GSTR 3B, we would have taken the credit, recipient would have taken the credit. So the date on which recipient avails the credit till the date of reversal of ITC. So whenever recipient reverses the ITC, until that point of time, interest is payable at the rate of 18% per annum. Now what if the payment is made at a later point of time? As and when the payment is made, whatever reversed ITC can be availed as ITC, but the interest is gone. Interest is a loss here. but this provision is not applicable in 3 cases. That is very, very important. Number 1, in case of RCM 9 subsection 3, this provision is not applicable. And then 15 subsection 2 clause B, that is supplier liability met by the recipient, means recipient is not making payment to the supplier, recipient is paying money to some other person, and that amount will be included in the invoice on which recipient would have taken the credit, but recipient did not make payment to supplier, it's okay. So then also credit can be taken. And then next we have something called as supply 71C, when there is no consideration at all where from recipient will make payment to the supplier. So these are the 3 exceptional cases where we can avail ITC, and that 180 days condition is not applicable. What are those 3 exceptions? 9 subsection 3 and 71C, and thereafter 15(2)(b). Then apportionment of credit and blocked credit. So with this, section 16 we completed, but 2 more points are there in section 16, that is depreciation. So in case of depreciation, that is given in 16 subsection 3. So whenever we purchase some capital goods, and when we purchase the capital goods, the GST is also paid on that capital goods, and now the GST paid on the capital goods is also included into the asset value while calculating depreciation, then we cannot take the ITC with respect to the GST component. And 16 subsection 4 is time limit for availment of ITC, when we should avail the ITC. So by 20th October of the succeeding financial year. Logic simple, September return of the succeeding financial year. September return means, so September return means GSTR 3B of September to be filed by 20th October. So 20th October of the succeeding financial year, or date of filing annual return, whichever is earlier, somewhere already which we have discussed. This is about credit note. In case of credit note also, the time limit is like the same way, but that is 30th September, not 20th October. So there it is 30th September of the succeeding financial year, or date of filing annual return, whichever is earlier, but here it is 20th October of the succeeding financial year, or date of filing annual return, whichever is earlier. This is the time limit for availment of ITC. We completed literally section 16. Now look into this illustration to understand the depreciation point. So illustration related to depreciation, say we made a purchase of capital goods. The value of the capital goods purchased, is 10 lakhs, and on that capital goods purchased, GST at the rate of 12%, say 1,20,000. So totally we are paying 11,20,000. So this is the total. So now in this case, whatever is the GST paid on purchases can be taken as credit. Okay. So but what happens here? So what is the entry that is being passed? Asset account debit 10 lakhs, and then ITC account debit 1,20,000 to bank 11,20,000. This is the entry I should have passed. So therefore depreciation is computed on 10 lakhs. Depreciation computed on 10 lakhs. Now in this case, can the ITC be availed? Yes, ITC can be availed. Suppose if the entry is in a different form, that is, say asset account debit 11,20,000 to bank 11,20,000, then definitely we will calculate depreciation on this. So depreciation computed on this. So then can the ITC be availed? No, ITC cannot be availed. Okay, ITC cannot be availed because what we did, first of all, we did not recognize the ITC. So therefore, due to that reason, sir, entry is correctly passed, sir, but depreciation is calculated on 11,20,000. Then also ITC cannot be availed. Okay, so this is related to 16 subsection 3. Now, apportionment of credit and blocked credits. In practical, but this payment detail is not mentioned in the GST portal. So related to this 180 days, maybe you will be getting lot of queries. That is, sir, how the recipient will know that the payment is not made to supplier? So he need to maintain the track. Will government know? Government will not know. It is a self-assessment exercise. which is to be done by the recipient. So if government comes to know about this fact during audit, if the GST department comes to know about this fact during the audit, so definitely they will ask that person to reverse the ITC and pay the penalty interest accordingly. And what if the credit period allowed by the supplier is beyond 180 days? In that case also, this section says that the credit period should be restricted to 180 days, because if the credit period may be more than 180 days, but the payment should be made within 180 days. Otherwise, unnecessarily the availed ITC will be reversed along with interest. Now we are moving on to apportionment of credit, section 17. And 17.1, 17.2, 17.3 deals with apportionment of credit. What is this apportionment of credit? Very, very simple. I have some inward supplies which are used exclusively for business purpose. I can take ITC. I am using exclusively for non-business purpose. Non-business purpose is two things. Non-business purpose means not used for this business, used for some other business is also non-business. Used for personal purpose is also non-business. So used for business, used for non-business. Used for non-business means not used in the current business but used for some other business is also non-business. Used for personal purpose is also non-business. Then I cannot take credit. If inward supplies are partly used for business and partly used for non-business purpose, then in that case can I take the credit? Yes, I can take the credit. But proportionate credit I can take, I cannot take the full credit. Same way, when inward supplies are fully used for taxable outward supply, we can take the credit. When inward supplies are used for exempted supplies, we cannot take the credit. Fully we cannot take the credit. What if inward supplies are partly used for taxable and partly used for exempted? Proportionate credit we can take. So therefore, this is given in 17 subsection 1 and 17 subsection 2. And thereafter, 17 subsection 3 deals with meaning of exempted supplies. So here you need to understand something, that is, zero rated supplies will be treated as taxable supplies for the purpose of availment of ITC. So this meaning of exempted supplies is important because it may not be exempted for payment of GST, but it will be treated as exempted for the purpose of availment of ITC. So this is something which I am just discussing. Therefore, meaning of exempted turnover. Meaning of exempted turnover is something which is very, very important. Meaning of exempted turnover. So there are two things: for the purpose of availment of ITC, for the purpose of payment of GST. For payment of GST, for payment of GST and for availment of ITC. For payment of GST, for availment of ITC. First, if you take non-taxable supplies, that is notified as exempted. If there is any supply which is notified as exempted, this supplies which is notified as exempted will be treated as exempted. Even for payment of GST, even for availment of ITC, it is treated as exempted supply. It is treated as exempted supply for payment of GST, even for availment of ITC, no doubt. Number 2, nil rated. Nil rated will also be treated as exempted supply for payment of GST. Exempted supply for payment of GST, even for availment of ITC, it is treated as exempted supply. And then number 3, non-taxable. Non-taxable supplies, that is alcoholic liquor for human consumption and petroleum products. So this non-taxable supplies will be treated as exempted supply for payment of GST. Even it will be treated as exempted supply for availment of ITC. Exempted supply for availment of ITC. Then there is something called as number 4. We have supplies under RCM. So supply under RCM, supply covered under RCM. This supply which is covered under RCM will be treated as taxable supply for payment of GST. So this is taxable. Yes, it is taxable. In whose hands it is taxable? In the hands of recipient. In the hands of recipient it is taxable. Correct or not? So GST is payable here. Of course, GST payable by recipient. So therefore it is a taxable supply. GST payable by recipient. GST payable by recipient. So therefore it is a taxable supply. But for availment of ITC, it will be treated as exempted supply. So this is something serious, which means that when my outward supply is covered under RCM, I cannot take GST paid on my inward supply as ITC. So this is about number 4. Number 5, sale of land. First of all, sale of land is not a supply for the purpose of payment of GST, but for the purpose of availment of ITC, it is treated as exempted supply. For the purpose of availment of ITC, it is treated as exempted supply. Okay. Exempted supply. And number 6, sale of building. So sale of building also the same. So actually it is not a supply. Sale of building when? Sale of building when entire consideration. So entire consideration is received. Entire consideration after completion certificate or first occupation, whichever is earlier. After completion certificate or first occupation, whichever is earlier. So this is not a supply for payment of GST, whereas it will be treated as exempted supply for availment of ITC. And then number 7, transaction in securities. Transaction in securities also same here. Transaction in securities, it is not a supply. For payment of GST, it is not a supply. But for availment of ITC, it will be treated as exempted supply. For availment of ITC, it is treated as exempted supply. So these are the 7 transactions which are treated as exempted supply for availment of ITC. Means for the purpose of availment of ITC, it should be taken into the exempted supply category, and proportionately the credit will be available. And here, even though there are some supplies which are taxable but treated as exempted supply, so that is this speciality. So in case of this point, if you see, even though it is taxable, but it will be treated as exempted for the purpose of availment of ITC. Whereas the next 3, if you see, it is not at all a supply for the purpose of payment of GST, but it will be treated as exempted supply. And then there are 2 more special points here in this regard. Point number 8, that is interest on loans, advances and deposits. Interest on loans or advances, or deposits. If you see, this interest on loans or advances or deposits will be exempted supply. It is exempted supply for availment of, for payment of GST. But for availment of ITC, it is treated as taxable supply. It is treated as taxable supply for the purpose of availment of ITC. And next, number 9, transportation of passengers by vessel. Transportation of passengers by vessel. From where to where? From India to outside India. From India to outside India. Actually, this is exempted supply for payment of GST. This is exempted supply for payment of GST. But for availment of ITC, it is treated as taxable supply. And then number 10, zero rated supplies. If you take zero rated supplies, so zero rated supplies, 2 options are available for payment of GST. Either we can pay IGST and get refund, or we can export it without payment of IGST. But for the purpose of availment of ITC, it is treated as taxable supply, which means always ITC can be availed. This is yet another area, that is, even though it is exempted supply or zero rated supply, but for availment of ITC, it is treated as taxable supply. These are the 10 points which you need to remember, so that any question that is given, you will be in a position to answer. Apart from these 10 points, if it is taxable supply for payment of GST, it is taxable supply for availment of ITC. If it is exempted supply, apart from this, if it is exempted supply for payment of GST, it is exempted supply for availment of ITC. If it is not a supply, if it is excluded from the supply, then ignore it for the purpose of ITC. It will neither come in taxable supply nor come in the exempted supply. So this is with respect to meaning of exempted supplies. That's what I have given here. What is the meaning of exempted supplies? Next. Now, why exempted supply meaning is very, very important? Because when we take the proportionate credit, there is a manner in which we take the proportionate credit. We should be having a clarity with respect to it. Generally, when we take credit when we take credit, proportionate credit when we take, what is the logic in which we take the credit? For example, let me give you an illustration to understand this. Say I am purchasing raw material 10,000 units, at the rate of rupees 100 per unit, excluding GST at 12%. Now this raw material partly I am using for exempted supplies and partly I am using for taxable supply. I don't know the quantity, inventory records I don't have. So I am using it partly for taxable supply and partly for exempted supply. I am using it. I don't have the inventory control. Suppose if I have the inventory control, definitely I will take the credit accordingly. For example, out of 10,000 units, if 8,000 units is used for taxable supply and 2,000 units is used for exempted supply, I will take the credit only with respect to taxable supply, 8,000 units only, 2,000 units I will not take. But here I don't have the information. Now I need to take the turnover data. So what is the turnover data? Taxable supply is 40 lakhs and exempted supply is say 20 lakhs. This is the turnover data. Based on this, generally what we will think? We will think that we will take the credit proportionately, correct or not? So, but we will not take the credit proportionately. There is a different process that we will be following. First, we will take the entire credit. ITC availed. Fully we will take the credit. Which means 10,000 into 100 into 12%. 10,000 into 100 into 12%. How much it comes to? So, it comes to 1,20,000. And minus ITC reversed. So first we will take the credit. Thereafter we will reverse the ITC proportionate to exempted supply. That is 1,20,000 into what is the exempted supply? 20 divided by total is 60. So 20 divided by 60 will be reversed. So what is 1,20,000 into 20 divided by 60? So 40,000. So it will be reduced. So then this is the net ITC available for set off, net ITC available for utilization. So the net ITC available for utilization is 80,000. So this is how you will do. Alternatively, we can also do it in a different way. Alternatively, we can also do it in a different way. What we can do? So ITC availed equals to 1,20,000 into 40 divided by 60, that is 80,000 we can take. 40 divided by 60, 80,000 we can take. But this is not being followed. Why it is not being followed? Matching will become a difficulty. Matching not possible. So that's why we will be going for the previous one. So what is the previous one? So first we will take the total credit. Matching is possible. Here matching is possible. This 1,20,000 will be matched. And thereafter we will reverse the credit that is attributable to exempted supply. Okay. So this is the process that we will follow, which you should remember. So in GST, first we will take the total credit and then we will reverse the credit attributable to exempted supply. Now, we are moving on to how that credit will be availed and reversed in case of inputs, input services and capital goods. For inputs and input services, we follow rule 42. For capital goods, we follow rule 43. So now I am discussing about rule 42, manner of availment and reversal of ITC in case of inputs and input services. What is that we need to do? First, we need to take total ITC on all inward supplies we need to take. Say there are some 100 invoices. And out of that 100 invoices, or we can take the total ITC as 10,000 rupees. I am just taking the numbers to explain to you how it will happen. So step 1 is that I will take the total ITC on all inward supplies. Say 10,000 rupees is the total ITC on all inward supplies. From this 10,000 rupees, I need to segregate how much is used exclusively for non-business and exclusively for exempted and blocked credit. So that is denoted as T1, T2 and T3. How much of this is exclusively used for non-business purpose? Say 500. How much is used for exempted supplies? Exclusively 1000. And how much is the blocked credit? 2000. So therefore 3500 rupees should be taken out. When you take out 3500 rupees from the 10,000, what is the baki that is left? 6500 rupees. That 6500 rupees you will take in the GSTR 3B. 6500 you will take as availment in GSTR 3B. So while please remember, when you take the credit, before taking the credit, you will take out the credits which are ineligible and blocked. So before taking credit in GSTR 3B, if you remember our discussion previously related to 2A 2B matching, there itself I told you, while taking the credit in 2A 2B matching, so remove from 2A 2B ineligible and blocked credit, and because in books also we will not be taking, that only will come in 3B. So therefore naturally that is what we are doing. So first we will be taking out the ineligible credit, means exclusively used for non-business, exclusively used for exempted, and blocked credit T1, T2, T3 we will take out, and the remaining we will be taking to the GSTR 3B. Now that goes into the availment of ITC. So this 6500 will be called as ITC availed. ITC availed. After availing ITC 6500, I need to reverse because I am using it for both taxable and exempted and business and non-business purpose. So I need to find a common credit. Out of the 6500, fully I have used something for taxable. So I need to take it out. Say 4000 is used for taxable purpose. Means 6500 minus 4000. So 2500 will be called as the common credit. What is 4000? ITC, which is exclusively used for taxable. 4000. So therefore remaining 2500 will be called as common ITC. So this common ITC only undergoes reversal, because exclusively for the purpose we will not reverse, only the common credit we will identify, and that common credit undergoes the reversal. And that common credit, if it is used for both exempted and taxable, both taxable and exempted, so how the reversal will be? Already just now we did an illustration. What we will do, total credit we will take. After taking the total credit, that is common ITC, into exempted by total. Exempted by total, in our example 20 divided by 60 something we did na. So like that. So that 20 divided by 60 exempted to total. So common credit attributable to exempted supply. What is a common credit attributable to exempted supply? In our example 2500 rupees. 2500 rupees is the common credit. Out of this, say 20 lakhs is the turnover of exempted supply and 60 lakhs is the turnover of total turnover. So 40 is taxable. Then how much is the credit attributable to exempted supply? Can you calculate that? 2500 into 20 divided by 60. So 833 rupees is related to exempted supply. Same way non-business purpose. How can I segregate? Partly used for business and partly used for non-business. I cannot segregate. If I can segregate at the stage of T1, T2, T3 itself, I would have segregated. Here I could not segregate. So therefore flat, ad hoc, some assumption should be taken. What is that? Common credit into 5%. Only when you have inward supply used for both taxable and exempted. Only when you have that. Only when your inward supply is used for both taxable and exempted, you should do this. 2500 into 5%. 2500 into 5% we need to take. So that is 125. 2500 into 5%, that is 125 should be taken. So that is D2. D1 is 833, D2 is 125. And if you take it out, this is known as ITC reversed. This is known as ITC reversed. So then the balance ITC is what we will take. So what is the balance ITC? Net eligible ITC. What is the net eligible ITC? 2500 rupees minus 833 minus 125. So 1542 is the net ITC that we will take. Okay. Which means that, so what we should do, already we have taken the ITC 6500. From that 6500 we need to reverse 833 and 125. So this is what we need to do. Availment of ITC is 6500. Reversal of ITC 833, 125. Remaining ITC we will enjoy. So this is the process or system that we need to follow. So this is for the purpose of rule 42, manner of availment of ITC in case of inputs and input services. Now, whatever I do this way, is it final? No, this is provisional, means monthly I need to do this way, and again at the end of the financial year, for the whole financial year I need to calculate once again. So first I am doing it monthly, and thereafter at the end of the financial year again I need to calculate, and when I calculate it at the end of the financial year again, Now I need to compare these two. So whatever I have done monthly and whatever is the total. So I need to compare this. Suppose if the total, that is annual D1 D2 is greater than monthly D1 and D2. So then the difference amount I need to pay. For example, annually when I do, why there is a difference? Maybe some assumptions could be changing or some points we may miss, etc. So whatever we have to calculate is the annual thing. So annual we need to calculate, and that annual whatever we have calculated D1 and D2 on an annual basis. That D1 D2 annual basis should be compared with D1 D2 on a monthly basis, sum of all months. Now D1 D2 annual is 1,20,000, but whatever monthly that we have calculated is 1 lakh, then 20,000 we need to pay. That 20,000 we need to pay along with interest. At what rate? 18%. From when? From the 1st April of the succeeding financial year, because this year we are doing, at the end of the financial year we need to compute whole year as well as monthly. So the difference, if any, so say 20,000, that should be paid, and if not, from April 1st till the date you pay, there will be interest. Suppose if D1 and D2 whatever you have computed annually is just 60,000, but what you reversed is 1 lakh, so 40,000 excess reverse, so that 40,000 can be availed as ITC. So that is this point. Sir, will they give any interest? No, they will not give any interest when you are taking the ITC. So this is the provisional ITC, provisional reversal versus comparison at the end of the year. So like this, we don't have comparison for Rule 43 capital goods. This comparison is only for inputs and input services. This is about Rule 42. Now friends, related to this Rule 42, if you have any doubts you can ask, or related to the points what we have discussed so far. For the last 1 hour whatever I have discussed, if you have any queries you ask, so that I will clarify those queries and then I will be proceeding to the next areas. So what was the 400 amount 4,000 deducted, sir? 4,000 deducted is exclusively for taxable. Exclusively for taxable. Exclusively for taxable. Okay. Whatever is the ITC that is exclusively taxable is 4,000. Any doubt here? Won't the interest be charged at 24% on reversal of ITC? Won't the interest be charged at 24% on reversal of ITC? No. Now we don't have 24% interest at all. Previously we used to have, but now 24% interest is not there. Only 18%. Then exclusion for 17.3 is transportation of goods, sir. Exclusion of 17.3. 17.3 is the meaning of exempted supply. So transportation of goods is not excluded. See, if you see this exempted supply, so meaning of exempted supplies, please repeat, sir. See, these are the 10 transactions which you need to understand. There are 7 points which are treated as exempted supplies. First 3 notified as exempted, nil rated, non-taxable. These 3 are treated as exempted both for payment of GST as well as for availment of ITC. These 3. Whereas the next one, supply covered under RCM, will be treated as exempted for payment for availment of ITC, which means when my outward supply is covered under RCM, I cannot take ITC on my inward supply. But for payment of GST, I am not treating it as exempted because I will not pay GST. My recipient will pay GST, but it is not an exempted supply. Then sale of land, sale of building and transaction in securities. This sale of land, sale of building and transaction in securities is literally not a supply. Why it is not a supply? Because these are excluded from supply, or it is not goods or services. But for the purpose of availment of ITC, it will be treated as exempted supply and we will inflate the value of the exempted supply based on this. Then interest on loans, advance and deposits, transportation of goods or goods from India to outside India by vessel. These 2 are actually exempted. We don't have to pay GST on that. But for the purpose of availment of ITC, it will not be treated as exempted supply. It will be classified under taxable supply. See, in that E by F ratio, all these are important. So we will take exempted to total ratio. There in that exempted to total ratio, this will be useful. Then zero rated supply, we have 2 options. Either we can pay GST or we may not pay GST. But for the purpose of availment of ITC, it will be treated as taxable supply. We can enjoy the ITC. This is the meaning of exempted supply. Okay. So next one, for common credit 2500, please explain sir. Simple here. First up to 6500 you got total 10,000. Out of 10,000, 500 rupees is exclusively used for non-business. So there is an invoice that contains 500 rupees tax, but that 500 rupees tax is, that invoice is purely used for personal purpose. Personal invoice, charge it to business. So we cannot take credit. Then there are some invoices that contains tax 1000 rupees, but these invoices are used for exempted supplies. So that also we cannot take. Then there are some invoices on which the tax is 2000 rupees, but these are blocked credit, specifically excluded. So we cannot take ITC. So remaining is 6500. Now in the 6500 rupees, on the 6500 rupees, so 4000 rupees out of the 6500, 4000 rupees is the tax component in invoices which are fully used for taxable supplies. So therefore that can be taken, 4000 can be taken. So we are not doing any cancellation because already 6500 taken. Now why we are excluding this 4000? Just to find out the common credit. Common credit means what? Used partly for taxable, partly for exempted, partly for business, partly for non-business. Now that is 2500. Out of this common credit, how much is used for exempted supplies we will find. So we don't have actual information. So we are taking a ratio. What is that ratio that we are taking? 20 by 60. Assuming that 20 is the exempted supply, 60 is the total supply. So 2500 into 20 by 60, 833 rupees is with respect to exempted supply, proportionate to exempted supply. Same way, how much is for non-business? We don't have the actuals. So we will take ad hoc. What is that ad hoc? Take the common credit into 5%. That will be towards D2. Okay, 2500 into 5%, 125. This 833 and 125 will be reversed. That is that we are doing. Okay. Next. And regarding the availability of ITC based on 2B, what happens if the supplier files only GSTR 1 and fails to file 3B, can avail ITC based on 2A, as the ITC will get reflected, however the tax would not have been paid. Yes, we can avail the ITC. So if at all he reports it in GSTR 1, but he is not filing GSTR 3B and paying, then also we can avail the ITC. We can. There is no restriction. We can avail the ITC. Okay, we can avail the ITC. So it is the supplier whom they will find. Suppose if there is a missing supplier, etc. and all, then in that case of missing supplier, so we can't do anything with respect to that. They will disallow the credit. So for that provisions are there. Suppose if the supplier is missing, then to that extent our credit will be suspended. We will not be able to take that. We will discuss in payment process. Okay. Then next, so we can take the credit. 16 subsection 2, second proviso, reversal of ITC for non-payment of consideration. Date of availment of ITC to be taken from which date? 20th of the next month or date of invoice? 20th of next month, because not 20th of next month literally, the date when GSTR 3B is filed. The date when GSTR 3B is filed, that date should be taken. GSTR 3B will be filed on one date, na? The date of filing GSTR 3B should be taken. That is the date of availment. For that month, we will file GSTR 3B, that date should be taken. So usually in exam, if they are not giving, we will take the due date. Okay. Then, how can ITC be availed on exempted supply as per GST taxable for last 3 items? How can we take ITC? Means they are telling that you should treat it like a taxable supply. So I did not say. So in the law itself, the lawmaker is telling that these three should be treated as taxable supply at the time of computing the ITC for availment of ITC, which means that, so while doing the ratio of exempted supply to total supply, there whether we need to put it under exempted supply or taxable supply, we need to put it under taxable supply. This is mainly for finding the ratio of exempted to total. Okay, not that on that we will take ITC and all, not on that supply. So it is like in turnover ratio. In turnover ratio, when you take exempted turnover to total turnover, there it should be treated like a taxable supply. Okay. Then next, is it transportation of goods or passenger through vessel or only goods? Only goods here. Transportation of goods. Sorry, it is only transportation of goods. Sorry. Transportation of goods by vessel. Sorry, I just overlooked it. So it is transportation of goods by vessel from India to outside India. Transportation of goods by vessel from India to outside India. Sir, but in section 16, supplier should have paid tax. That's what I explained, that condition clearly I told. How the recipient will know whether the supplier has paid tax or not. For that reason, what is the clarification that is provided? Whenever recipient gets the GSTR 2A 2B information, on that basis he will take the credit, means the assumption is that supplier is paying tax. Okay, so recipient will not come to know that information due to that reason. Can ITC be taken without having a invoice? But in R1 it is reflected. R1 is reflected. I didn't get you what is R1. Okay, GSTR1. Okay, can ITC be availed without having invoice? Even though it comes in 2A 2B, we cannot take. Even though it comes in 2A 2B, we cannot take. Okay, even though it comes in 2A 2B, we cannot take. We cannot take if you are not in possession of tax paid document. Done? So all your doubts got clarified? Now, I am moving on to the next area. Sir, interest on loans or advances is for other than banks in the meaning of exempted supply? Yes, yes. So this interest on loans or advances or deposits, this is for other than bank or NBFC. Other than bank or NBFC. So for bank or NBFC, it will be treated as exempted supply even for payment of GST as well as for availment of ITC. It will be treated as exempted both for payment of GST as well as availment of ITC. For bank or NBFC, for others only, interest on loans or advances or deposits other than bank or NBFC. Then anything else? That's it. Now, after completion of rule 42, now we are moving on to rule 43. What is this rule 43? So rule 43 says that whenever we have some capital goods, that capital goods is used for taxable supplies, so then we can enjoy the credit. So there is no restriction. Whenever we have purchased some capital goods which is used for exempted supply, we cannot avail the ITC. Whenever some capital goods are purchased which is partly used for taxable supply and partly used for exempted supply, or partly used for business purpose, partly used for non-business purpose, in that case, take the credit. Take the credit and reverse it proportionately over a period of 60 months or less than 60 months. So here we can take the life of the capital goods as 60 months, up to 60 months. We can take even 48 months or 36 months also as life of capital goods. But usually 60 months will be taken, but there is no thumb rule like only 60 months should be taken. We can take the life of the capital goods for less than 60 months also. So in exam, suppose if they give less than 60 months, we can take that. So we cannot write that 60 months should be there because the words are now up to 60 months. Previously it was flat 60 months. Now they have replaced it to up to 60 months. So when capital goods are exclusively used for taxable supply or business purpose, taxable supply or business purpose, taxable supply or business purpose, ITC can be availed. Whenever capital goods are exclusively used for exempted supply or non-business purpose, then ITC cannot be availed. Whenever capital goods are partly used for business purpose and partly used for exempted supply, like partly used for taxable and business, partly for exempted or non-business purpose, then ITC can be availed. Yes, ITC can be availed. But that ITC availed, we cannot fully avail. We need to reverse it for the next 60 months. See that. What is that we need to do in case of capital goods too? First, you avail the 100% ITC with respect to GST paid and transfer to electronic credit ledger. For example, if 10 lakhs is the worth of capital goods, 10 lakhs on that GST paid is 1,20,000. Now this 1,20,000 first we will take as credit and transfer to the electronic credit ledger. Thereafter we need to calculate monthly ITC. What is a monthly ITC? 1,20,000 divided by 60 months. Therefore 2,000 rupees will be taken as monthly ITC. So we are taking the assumption life of capital goods as 5 years, 60 months, maximum 60 months. We can take less than that also. 2,000 rupees is the monthly ITC. Now what we will do with the 2,000 rupees? That 2,000 rupees we will reverse every month. So 2,000 rupees into what proportion? How much is used for exempted supply based on that? So 2,000 into exempted supply divided by total supply. So 2000 into exempted supply for that month divided by total supply for that month. Say for example, in a particular month, exempted turnover is say 20 lakhs and the total turnover is 100 lakhs, then 240 rupees will be reversed. Okay, 240 rupees will be reversed. So 2000 into 20 divided by 100, 240 will be reversed. 20 is exempted turnover, 100 is total turnover. And this 240 rupees reversed means what? It will be added to the liability. So if there is no balance, if there is balance, it will be adjusted from there along with interest at the rate of 18% per annum. But this interest on reversal of capital goods rule 43 is not given in ICA study material, but this interest is there. But in practice, this interest is not there. So due to that reason, they have not given in the study material, but interest is there. And the rate of 18% per annum from the rate of availment of ITC till the rate of reversal of ITC. Means for every month we need to do this way. Yes. How many months we need to do? 60 months we need to do. Means for 60 months we need to calculate from the date of availment till the date of reversal. For 60 months we need to calculate interest. Yes. But not on entire amount, only on the amount that we are reversing. The above procedure not required from the month when capital goods are sold. Suppose if the capital goods are sold, then the capital goods itself I don't have. Then why I need to reverse it for the balance life? I don't have to. Say for example 24 months I use the capital goods and thereafter I sell it. So then for the remaining life I don't have to do any reversal, monthly reversal. Okay. So this is about rule 43. Now what will happen? There are some special situations arising in this. Initial purchase I have used it for CG1, means exclusively for taxable. At a later point of time I am using it for both taxable and exempted. Now what is the treatment? This treatment is revised. So what we need to do? First we need to, at the time of initial purchase, so sorry here, this is 400 na, not 240, this is 400, correct? 2000, 10% is 200, so 400, sorry, 400 rupees will be reversed. Okay, see this, initial purchase CG1 and at a later point of time CG2. So at the time when we purchase itself we are using it for taxable, and at later point of time we are using it for both taxable and exempted. In that case, what is that we need to do? So we need to first take the credit here. First we need to take the credit. So we will, already we have availed ITC, so no need to take the credit now. At the time of purchase itself we would have taken because it was used for taxable. But now what we need to do? We need to consider it as common capital goods, and for the balance life we need to reverse the ITC. So life you consider as 60 months. For example, 2 years you have used. So remaining 3 years, that is 36 months, you need to do the reversal. Please see, first all ITC already availed at the time of purchase. So no need to avail any common credit, but it will be taken for computation of common credit. Monthly ITC equals to original ITC by 60 months. Now proportionate reversal from the date of conversion for the balance life, for the balance useful life. Now second point, initial purchase I am using it for exclusively exempted. At a later point of time I am using it for both taxable and exempted. In that case what I need to do? So ITC at the time of purchase I have not taken because I was using it for exempted. Now the date when it became common, that is used for both taxable and exempted, I will be taking it as credit. So when I am taking it as credit, how much I should take as credit? Full GST paid you take as credit. See the first step. ITC not availed at the time of purchase, so it should be availed now. How much should be availed? Original GST paid should be availed. Now, ineligible ITC to be reversed for the period, it is used for exempted. Whatever is the ineligible ITC that I need to reverse. So, ineligible ITC will be equal to GST paid into 5% into number of quarters or part thereof from the date of purchase till the date of conversion. So what should be taken as the ineligible ITC? So this ineligible ITC is like bulk reversal, For example, 2 years I am using it for exempted. Now for 2 years, first of all I should not take the credit, but I have taken the credit. Now I am recognizing. For example, you take 10 lakhs and GST paid is 1,20,000. Now what you will do? I'll take 1,20,000. I'll take 1,20,000 as the credit, and 2 years it is used for exempted. 2 years it is used for exempted. When 2 years it is used for exempted, then 1,20,000 into 5% into 2 years means 8 quarters. So that is known as bulk reversal. So therefore 1,20,000 into 5% into 8 quarters, so 40. So 1,20,000 into 40% is what? 48,000. 48,000. So 48,000 will be reversed. Bulk reversal. Now what is the monthly ITC? Should I take monthly ITC as 1,20,000 minus 48? No, it is not 1,20,000 minus 48, 1,20,000 only. 1,20,000 divided by 60, 2,000 rupees I need to take, and I need to reverse it for the balance useful life. I need to reverse it for the balance useful life. 2 years is used for exempted. Now 3 years I am using for both taxable and exempted. So for balance useful life I need to reverse the ITC accordingly. That is 2,000 rupees monthly ITC into exempted supply of that month divided by total supply of that month. And along with interest, that is common. So these are the two special treatments which needs to be followed. And there are some illustrations related to this. So please try those illustrations. Then this is about rule 43. Any doubt related to rule 43 here? Rule 42 we completed. Any doubt related to rule 43? Any doubt related to rule 43? No. Fine. Whatever doubts that you have related to rule 43, you please type and keep. So I will proceed to the next area. Special provision for availment of ITC by banking company and financial institution including NBFC. Section 17 subsection 4. What we have seen so far is 17.1, 17.2, 17.3 apportionment of credit along with rule 42 and rule 43. This 17 subsection 4 is in case of a bank, financial institution or NBFC. So their outward supply, bank, financial institution or NBFC's outward supply is divided into two. Interest income and other income. Interest income will be tax exempted, whereas other income will be taxable. Sir, interest income is exempted, but for availment of ITC, won't it be treated as taxable? No, that will not be treated as taxable because interest on loans or advances will not be, that is that point, whatever we have discussed is not applicable in case of banking company, financial institution or NBFC. Interest on loans or advance or deposits other than bank or financial institution. So for bank or financial institution, it will be exempted for payment of GST as well as for availment of ITC. So for both it will be treated as exempted. So therefore that interest point which is exempted for payment of GST and taxable for availment of ITC is not applicable for a bank, financial institution or NBFC. So therefore in this case, so part of their outward supply is taxable and part of their outward supply is exempted. Interest income is exempted. Interest on loans, advances, deposits is exempted and other income will be taxable. Now they have two options here. Option number 1, take the proportionate credit. Proportionate credit as per rule 42-43. That is option 1. Or option 2 is there. What is option 2? Ad hoc. That is 50%. What is the logic in that? 50% is assumed to be exempted supply. Means interest income is assumed to be 50%. Suppose if the other income is 60% and I will be getting 60% of the credit. So it is not advisable to go for option 2. So it is advisable to go for option 1. If the other income is somewhere 40, 30 and all, so then I will get credit only 30%. If the other income is only 30%, interest income is 70%, I will get credit only 30%. So it is advisable to go for option 2 because under option 2, how much reversal? Only 50% reversal. So that is option 2 ad hoc. But this option 2 ad hoc has got some special points, please see. That is what we need to do. First, if it is exclusively used for non-business and exempted, ITC should not be availed. So remaining 50% we should take and 50% will be lapsed. And this restriction of 50% is not applicable in case of inward supply from a distinct person. For example, HDFC Bank Tamil Nadu is receiving service from HDFC Bank Karnataka. On that 50% reversal they don't have to do, they can take fully credit. So 100% they can take. So within the same entity. And option 1's exercise cannot be withdrawn during remaining part of the financial year. Means every financial year we need to decide whether to go for option 1 or option 2. This is with respect to special provision for bank, financial institution and NBFC that is given in 17 subsection 4. 17.1, 17.2 apportionment of credit, 17.3 meaning of exempted supply, 17.4 special provision applicable for bank, financial institution and 17 subsection 5 is blocked credits. We are moving on to the next area that is blocked credit, section 17 subsection 5. What is this blocked credits? Blocked credits means ineligible credits on which you cannot take ITC. And say for example, so motor vehicles, first one motor vehicles. Motor vehicles is blocked credit, which means you purchase motor vehicle, on that you pay GST, you cannot take it as credit. So motor vehicles related blocked credits. Motor vehicles are divided into 3. So motor vehicle for transporting persons, motor vehicle, vessel and aircraft and motor vehicles that is others. So if it is others, always ITC available, there is no restriction. So the restriction is only in case of motor vehicles for transportation of persons and vessels and aircrafts. Others means motor vehicles for transportation of goods, there is no restriction, we can always take ITC. With respect to motor vehicles used for transportation of persons, that is divided into two. Capacity does not exceed 13 and capacity exceeds 13. If the capacity exceeds 13, there is no restriction, we can always take the ITC. While calculating 13, we need to include the driver. While calculating 13, we need to include the driver. Including driver, if the capacity exceeds 13, there is no restriction, we can take ITC. If the capacity does not exceed 13, so which means like cars, next motor cabs or maxi cabs, even tempo travelers, that will come into this category. So if it is used for further supply, so there are three cases where we can take ITC. If it is used for further supply, or if it is used in the business of transportation of passengers, or if it is used in the business of imparting driving skills, ITC available. If it is for any other purpose, then ITC not available. For example, there is a chartered accountant who purchased a car. So whether ITC available on that car or not, we need to check. First of all, car is motor vehicle for transportation of persons. Capacity does not exceed 13. Whether it comes in the exceptions? No. It is not used for further supply. Number 2, it is not used in the business of transportation of passengers. Number 3, it is not used in the business of driving school. So which means ITC not available in that case, like that. Say for example, a car driver purchased, a travel agency purchased a car for the purpose of transportation of passengers. First of all, car, again, capacity, persons, transportation of persons, car used for transportation of persons. So the capacity does not exceed 13 and it comes in the exception used in the business of transportation of passengers. Therefore, ITC is not available. So why ITC is not available? ITC available if it is used in the business of transportation of passengers. So they are purchasing it, and are they using it in the business of transportation of passengers? If yes, ITC available. If they are not using it in the business of transportation of passengers, ITC is not available. Okay, so that is this. Then vessels and aircraft. Vessels and aircraft, we have 4 exceptions. These 3 are common. That is further supply, and number 2, used in the business of transportation of passengers, and number 3, driving schools. Number 4, used for transportation of goods. Used for transportation of goods means that, so they are not in the business of transportation of goods, but they are using it for transportation of their own goods also, they can take ITC. But business of transportation of passengers means it should not be used for their own purpose, but used in the business of transportation of passengers. For example, Indigo Airlines purchased an aircraft. Can they take ITC? Yes, because they are using it in the business of transportation of passengers. Reliance Industries Limited purchased an aircraft for transportation of its director. They cannot take ITC because it is not in the business of transportation of passengers. Now the same Reliance company purchased an aircraft for transporting goods. So it is for their own purpose, then also they can take ITC. If they purchase an aircraft for using it in the business of transportation of goods, for example, this first flight couriers, DHL, etc., these people, they are using it in the business of transportation of goods. So then also they can take ITC with respect to that vessels and aircraft. If it is apart from these 4 cases, any other case, vessel and aircraft purchase, ITC not available. So this is about the motor vehicles related blocked credit. Now, so this is as such related to motor vehicles. Now, there are 4 services in relation to motor vehicles: repair and maintenance service, insurance, servicing, hiring, leasing and renting of motor vehicles. Repair and maintenance, normal, understandable. Servicing means authorized service station. Insurance on motor vehicles. Then hiring, leasing and renting of motor vehicles. These 4 services are in relation to motor vehicles. Motor vehicles used for, like motor vehicles, we can take ITC. When we can take ITC on motor vehicles, with respect to these 4 services also, GST paid can be taken as ITC. If motor vehicle is not eligible for ITC, then with respect to these 4 services, GST paid cannot be taken as ITC. So let's try to understand with 2 examples. Say for example, there is one company which has taken a cab on rent. So the company taking cab on rent, so that rental charges they pay GST, can they take ITC or not on that rent? First of all, if they buy a cab, can they take ITC? No. If they buy a car, capacity does not exceed 13 and not coming under exceptions, they cannot take ITC. So with respect to renting also, they cannot take ITC, like that. And say for example, there is a person who is in the business of transportation of passengers and they gave their cars for servicing. So for servicing, they paid some service charges along with GST. Can they take it as ITC? Whether cars are eligible for ITC? Yes. So motor vehicle is eligible for ITC. Therefore, that servicing also is eligible for ITC. So these 4 services in relation to motor vehicle. If motor vehicle is eligible for ITC, these 4 services are also eligible for ITC. If motor vehicle is not eligible for ITC, these 4 services, whatever GST paid, is not eligible for ITC. And there are some key points in relation to this. What is the meaning of further supply? Further supply means not only sale but also renting. Means I am into the business of renting of motor vehicles. I buy a motor vehicle for giving it an rent. Can I take ITC? Yes. Further supply means what? Further supply means not only sale but also renting, hiring or leasing. Then repair, insurance and servicing of motor vehicles received by a general insurance company is always eligible for ITC. What does that mean? So it means that, say there is an insurance company which is providing us the insurance with respect to a motor vehicle which met with an accident. So they will be paying the repair expenses. On that repair expense, they pay GST also. So that GST can be taken as credit. Yes, naturally they can take as credit. Then, suppose if hiring, renting or leasing of motor vehicles is under a statutory obligation, then also ITC available. So this is another exception. For example, there is a company which is working in the night shifts. So that company has taken the car on rent for transporting their employees. Generally, it is a blocked credit. They cannot take ITC because that car, if they purchase, they cannot take ITC. So on that rental also they cannot take ITC. But if it is a statutory obligation, say government has given an order that they need to transport their employees who are working in the night shifts, then it is under a statutory obligation if they receive these renting services. So GST paid can be taken as credit. It's not about business or non-business here. All these are for business purpose. Even then it is a blocked credit. So this is like exception to 16. Section 16 says that if you are using it in the course or furtherance of business, you can take ITC. But in this case, even though you are not using it in the business, in the course or furtherance of business, or not, that is irrelevant here. Means even though you use it in the course or furtherance of business, it is a blocked credit here. Okay. So that is this point. Next, ambulance and caravan. Ambulance and caravan are not motor vehicles for transportation of persons. So these are specially designed motor vehicles. So specially designed motor vehicles, so always eligible for ITC. Okay. So these are the 4 points related to that motor vehicle special points. So we completed motor vehicles related blocked credit. Now we are moving on to the second area. First one is motor vehicle related. Second is construction related blocked credits. What is this construction related blocked credits? Very, very simple. There are 3 inward supplies. Number 1, works contract service or any service in relation to construction or any goods purchased for construction of what? Immovable property. I am constructing an immovable property. I will buy any goods. I cannot take ITC. I will be receiving any services. I cannot take ITC. I will be receiving works contract service from a builder. I cannot take ITC. Okay. If it is construction of an immovable property, means this restriction is applicable to whom? The owner of the immovable property, not to the builder. Means if builder purchasing goods, can he take ITC? Yes. If builder receiving input service, can he take ITC? Yes. So, but the restriction is only to the recipient, that is owner of the property. That is the first exception. And second is that if suppose that expenditure is charged to P&L, then also they can take ITC. So if the construction, what is the meaning of construction? So construction expenditure should be charged to P&L. Is not treated as construction. Only when it is capitalized, it is treated as construction. So therefore, if I incur some repair expenditure, renovation expenditure, if that expenditure is charged to P&L, can I take ITC? Yes, I can take ITC. That is the second exception. And third exception, plant and machinery. Suppose if this construction is in relation to lift, escalator, etc., plant and machinery. So in that case, I can take ITC even though it is immobile in nature. But plant and machinery excludes telecommunication towers and pipeline laid outside factory. For constructing a telecommunication service, if I receive any construction service or any service in relation to construction, I cannot take ITC. Why? Because plant and machinery excludes telecommunication towers and even pipeline. So which means that in case of telecommunication towers and pipeline laid outside the factory, so whatever inward supplies, can I take ITC? No, I cannot take ITC even though it is in the nature of plant and machinery. Okay. So these are the three exceptions to this construction services. So very simple here. First three service, that is any service, works contract service or goods purchased or received in relation to construction of an immovable property, ITC not available on those inward supplies. Works contract involves transfer of property in goods as well as provision of service for a single consideration. Exception, the above discussion is not applicable to supplier. That is, if works contractor receives construction service, can he take ITC? Yes, he can take ITC. Then second, construction of plant and machinery even though immobile, but plant and machinery excludes telecommunication towers and pipeline laid outside factory. Number 3, if construction expenditure is charged to P&L, then also ITC can be availed on above inward supplies. Okay, suppose if the construction expenditure is charged to P&L, I told you it is not construction, so ITC is available. These are the three exceptions related to that. Now we are discussing other blocked credits. So first motor vehicle related, second construction related, third other blocked credits. That's it. So I have just minimized it to a greater extent. So now what are these other blocked credits? Membership of a club, health and fitness center. So we are taking membership of a club, membership of a fitness center, etc. Even though it is for business purpose, but it is a blocked credit. But there is an exception. If it is provided by employer to employee under a statutory obligation, ITC available. Then number 2, travel benefits extended to employees on vacation. So there is a company which is extending the travel benefits to their employees on vacation. So vacation expenditure is borne by the company. In that case, it is a blocked credit. Suppose if the travel benefit is to be extended to employees under a statutory obligation, so under a statutory obligation, if they are doing like leave, travel concession, etc., in that case, whatever GST paid can be taken as credit. Then NRTP, non-resident taxable person. Who is a non-resident taxable person? A person who comes from outside India to India for making supplies in India is known as a non-resident taxable person who is not having physical place of business in India. So this person, when he comes to India, he need to get the registration, temporary registration, but compulsorily he should get, and that particular person cannot take ITC on any inward supplies except import of goods. When he import goods, on that IGST paid, that alone can be taken as credit, but within India, any services or goods purchased on that GST paid cannot be taken as credit. That is about NRTP. Then next one, there are few inward supplies, food and beverages relating to food and beverages, outdoor catering related to food. Then related to beauty treatment, cosmetic, plastic surgery. Okay. Then next one, third, insurance, life insurance and health insurance. In 3 points you can remember. Food related is food, beverages, outdoor catering. And then beauty related means beauty treatment, cosmetic, plastic surgery, hair transplantation. And number 3, that is insurance, that is health insurance and life insurance. These three categories of services, whatever we receive on that GST paid cannot be taken as credit even though it is for business purpose. But there are exceptions to this. 3 exceptions are there. Exception number 1, if inward supply and outward supply is in the same category. For example, I am engaged in the business of supply of food. I purchase food and I sell food. Can I take ITC with respect to this food and beverages? Yes. Number 2, so inward supply is part or component of the taxable outward supply or mixed supply. I am into the business of transportation of passengers by airways. Now I receive services of outdoor catering. Can I take ITC? Yes, because it is part of the composite or mixed outward supply, so I can take ITC. Then third exception is statutory obligation. Say there is a factory which needs to provide food to their employees, so they are receiving outdoor catering service. Can they take ITC? Yes. So these are the 3 exceptions under a statutory obligation incurred by employer to employee. Then in the balance cases, see, from a person opting for composition scheme, that is apart from this other blocked credits. Suppose if I am purchasing from a person who is opting for composition scheme, definitely I cannot take ITC with respect to GST paid. First of all, he should not recover GST from me. If he recovers GST from me, I cannot take ITC. Already we discussed it in the meaning of input tax. Then any goods purchased used for personal consumption, that already we discussed in section 16 itself, that it should be used or intended to be used in the course or furtherance of business. If it is for personal purpose, we cannot take ITC. Suppose if the goods are purchased which are lost, destroyed or written off. That may be for any reason, natural reason or abnormal reason. So goods are lost, destroyed, written off or disposed of as gift or free sample. We cannot take ITC with respect to that goods purchased. So these are the blocked credits that we have in 17 subsection 5. In simple 3 headings, I completed the entire block credits under 17 subsection 5. We are starting with section 18 now. Section 18, section 16, section 17 we completed. Now section 18. What is section 18? Input tax credit in special cases. So that is, first there is 18 subsection 1, availment of ITC on closing stock. What is this availment of ITC on closing stock? There are 4 situations given: 18.1a, 18.1b, 18.1c and 18.1d. 18.1a is that you are liable to get registered and you made application for registration within 30 days. Now so much of the GST paid on closing stock, immediately before the date you are liable to get registered, you can take that as ITC, because that closing stock will be used for payment of outward supplies. So that closing stock will be used for making outward supplies after the date you are liable to get registered. So therefore you can enjoy the credit on the closing stock. Again I am repeating, please listen carefully. Say for example, from today you are liable to pay GST, you are liable to register and you are liable to pay GST. Then whatever is the closing stock as on yesterday will be used for making outward supply from today. So as you are paying GST on outward supply, you can enjoy the ITC on that closing stock. So that's what 18.1a says. Whatever is the closing stock as on yesterday, on that GST paid can be taken as credit under 18.1a, provided the application for registration is made within 30 days. Say this: liable to get registered and applied within 30 days. That is 18.1a. Inputs in stock, inputs contained in WIP in stock, inputs in FG in stock can be taken as credit. What is the meaning of closing stock? Closing stock will be segregated into 3: raw material, WIP and FG. So in raw material, whatever GST paid we will take, whatever is the raw material closing stock. WIP closing stock, find the raw material content in the WIP. On that raw material, whatever GST paid we can take as credit. Then in FG, find whatever FG is in the closing stock. In that FG, what is the raw material content you find, and raw material whatever GST paid we can take as credit. Okay, so that is the meaning of closing stock here. And when, which date? Immediately preceding the date on which he is liable to get registered. Okay, whereas suppose if he voluntarily get registered, then suppose if that person voluntarily got registered, 18.1b. What does 18.1b says? 18.1b says when a person voluntarily make application for registration, now he is liable to pay GST from the date when he gets registration certificate. Say today he got registration certificate, as on yesterday whatever is the closing stock, on that GST paid can be taken as credit. Same logic. Okay, so date alone differs, situation differs. So remaining concept is same between 18.1a and 1b. Now 18.1c. I am going from composition scheme to normal scheme. So under composition scheme, I would not have availed ITC. Under normal scheme, I can avail ITC. Say from today, I am entering into normal scheme. Now whatever is the closing stock as on yesterday will be used for making payment of GST, making outward supplies during today, from today, and therefore I can avail the ITC on that closing stock. But what is the meaning of closing stock here is not only inputs, as such inputs in WIP and inputs in FG, but even on capital goods we can take the credit. How much credit we can take on capital goods? So full ITC, whatever is the original ITC that is paid, as reduced by 5% for every quarter or part thereof. So in case of capital goods, how much credit can be taken here? How much credit can be taken on capital goods? How much credit can be taken on capital goods? So ITC shall be GST paid on capital goods as reduced by 5% for every quarter or part thereof from the date of purchase till the date of conversion. That should be taken out, and remaining credit I will take on capital goods. Say the capital goods is used for 3 quarters. So 3 into 5, 15% will be taken out, and remaining credit I will take now. Okay, that is in case of capital goods here. That is in case of capital goods. In case of capital goods. And then which date we need to take closing stock? Immediately before the date I am going from composition scheme to normal scheme. Same way, I am a registered person and my outward supplies are exempted. So I would not have taken credit on inward supply. Now my outward supplies becomes taxable. When my outward supplies becomes taxable, so much of the GST paid on closing stock can be taken as credit. Say from today my outward supply becomes taxable. As on yesterday, whatever is the closing stock on the GST paid can be taken as credit. And what is the meaning of closing stock here? Same. For 18(1)(c) or 18(1)(c), that is inputs as such held in stock, inputs in WIP, inputs in FG and capital goods. Okay. So between 18(1)(a), 1(b), 1(c), 1(d), extra whatever benefit that we get is capital goods. Now, this is the position of availment of ITC on closing stock. 18(1)(a), registered person, that is a person is liable to get registered, make application for registration within 13 days. 18(1)(b), voluntary registration. 18(1)(c), composition scheme to normal scheme. 18(1)(d), outward supplies which are exempted is now becoming taxable. In all these 4 cases, whatever is the closing stock, on that closing stock, GST paid can be taken as credit. And 18(1)(a), 1(b) closing stock meaning is input as such held in stock, input in WIP, input in FG. And for 18(1)(c), 1(d) closing stock is input as such, inputs in WIP, inputs in FG, extra capital goods. Which date? 18(1)(a), before the date the person is liable to get registered. 18(1)(b), before the date the person actually got registered, registration certificate. 18(1)(c), the date on which he enters into normal scheme. 18(1)(d), when his exempted supplies becomes taxable. Okay. Now, 18 subsection 2, there is a time limit. So, this closing stock should have been purchased within 1 year as on the date of closing stock. Suppose that is from the date of invoice to the date of closing stock, it should be within 1 year. If it is beyond 1 year, we cannot take ITC with respect to that. So we have in the closing stock some goods which are purchased 3 years, 4 years before. On that we cannot take ITC. So we need to check whether it is purchased within 1 year before. Means invoice date to the closing stock date should be within 1 year. Even for capital goods, the same point will be applicable. Then some special points in this regard. ITC with respect to GST paid on inputs can be availed as ITC. No need to reduce anything, but for capital goods we need to reduce. How we will take this ITC? Whether we show it in GSTR 3B? No. We will avail this ITC separately by filing a form called as ITC 01. For availment of ITC on closing stock, we need to file a separate form called as Form GST ITC 01. Through filing that form GST ITC 01, we will take the credit. And what is the time limit within which that form should be filed? Within 30 days from the date, relevant date. What is relevant date? The date I am liable to, like the date when I get registration certificate within 30 days, or the date when I am entering into normal scheme within 30 days, or the date when my taxable supply, exempted supply becomes taxable supply 30 days from that, or such extended period. Okay. Now, this declaration in ITC 01 is under a self-declaration. Suppose if the ITC amount, how much ever amount that we take as input tax credit exceeds 2 lakh rupees, then that should be certified by a chartered accountant or a cost accountant. Okay. If the claim of ITC exceeds 2 lakhs, then that should be certified by a chartered accountant or a cost accountant. Okay. Then section 18 subsection 3, transfer of ITC. Transfer of ITC. When there is a transfer of ITC, input tax credit, in that case 18 subsection 3 is applicable. Why there is transfer of ITC? Because of transfer of business. So there is a transfer of business, amalgamation, merger, demerger, or succession, inheritance, everything. Transfer of business as a going concern with specific provision for transfer of liabilities. Then in that case, that is important, with specific provision for transfer of liabilities, then whatever is the unutilized ITC in the electronic credit ledger of transferor will be transferred to the electronic credit ledger of the transferee. For that, one form needs to be filed, that is ITC 02. ITC 02, and this should be certified by a chartered accountant or a cost accountant that there is a transfer of business with specific provision for transfer of liabilities. Then only it will be called as transfer of business as such as a going concern. If all liabilities are paid off and if only assets are transferred, that will not be called as transfer of business. Okay. Then in case of merger, of two companies into a single company, there is no problem. Say for example, A Limited and B Limited gets merged into AB Limited. A Limited ITC, B Limited ITC will go to AB Limited. But when AB Limited gets demerged into A Limited and resulting company B Limited, then in that case, so whatever is the credit in AB Limited will be segregated to these two companies on their assets ratio post demerger. Post demerger, whatever is their assets ratio, total assets ratio, including the value of the assets on which they have not taken any ITC, total assets excluding this ITC, whatever is the total assets, in the total assets ratio it will be distributed. Okay. Then if there is any transfer or change in ownership, even that will also considered as transfer of business. Yes, there is a sole proprietor who is dead and the business is transferred now to his son. So now his son can take credit. Yes, his son can take the credit. There is no restriction with respect to that. His son can take the credit and his son only will file the form ITC 02 in his father's name and the credit will come. But definitely he cannot continue the business in the same name, in the sense same legal owner. So he need to get registered and old registration needs to be cancelled. Remember, every time when there is a transfer of business, the transferor should cancel their registration and transferee should obtain new registration. Then, now this ITC 2A, one new form is there. What is that? That is when a single registration gets separated into multiple registrations within the state. Within the state, we have an option whether to go for a single registration or separate registrations. When the single registration gets separated into multiple registrations, in that single registration, whatever is ITC, that will be distributed to the multiple registrations in the assets ratio of on the date of registration. On the date of registration, that is single registration gets separated into multiple registrations now. On the date of that registration, that is single registration getting separated into multiple registrations, on that date, whatever is the turnover, in the turnover ratio, it will be distributed. What will be distributed? ITC will be distributed. For that, they need to file a form ITC 02A. These informations are given in 18.3. Now we are discussing 18 subsection 4 read with section 29 subsection 5. That is 18.1 is availment of ITC on closing stock, but 18.4 is reversal of ITC on closing stock. There ITC availment on closing stock, here ITC reversal on closing stock. When that reversal will arise, so look into this. So these situations are common for three. Number one, that is whatever we discuss now, the treatment is common for three cases. So that's why I have referred 18 subsection 4 with section 29 subsection 5. Whenever you are under normal scheme and you enter into composition scheme, this is applicable. And whenever you are making outward supplies which are taxable becomes exempted, then also it will be applicable. So this is opposite of 18.1c and 18.1d. And then cancellation of registration. Okay. Say with effect from 1/4, you are entering into composition scheme, or your taxable supplies become exempted, or there is a cancellation of registration. Immediately before that date, whatever is your closing stock, that is inputs, WIP, FG, you should take. In the WIP, FG, you should take the value of inputs. On these inputs, we need to reverse the ITC. Whatever is the GST paid, so that should be reversed. ITC reversed equals to GST paid. Then capital goods you need to take. On capital goods, we need to calculate total GST paid divided by 60. Life is taken as 60 into balance useful life, we should reverse. So GST paid divided by 60 months into balance useful life, we should reverse. So this is the reversal of ITC. If I have that much balance in ITC, it will be reversed, and still if there is any excess balance, that will be lapsed. Suppose if there is any deficiency, I need to pay that. Say this. Additional points, inputs and capital goods can be purchased anytime. So in case of availment of ITC on closing stock, 1 year it should have been purchased. But 18 subsection 4 read with 29 subsection 5, the inputs and capital goods can be purchased any time on which ITC is availed. If ITC is not availed on such inputs and capital goods, reversal shall not arise. If capital goods is purchased before 5 years on which ITC is availed, then reversal shall not arise because the life is 60 months. Then Tran 1 credit should be considered if inputs and capital goods are purchased in earlier tax regime. So earlier tax regime we purchased inputs on capital goods. Now we need to reverse the ITC. So whatever is the Tran 1 credit you should check. Suppose if invoice is not available, then in that case the market value as on the date should be considered, and that should be certified by a practicing CRCMA. That is, say we purchased some inputs and capital goods and we need to reverse the ITC pertaining to that. We don't have the invoice, so invoice value we don't know. In that case, as on the date, which date? As on the date of the closing stock, you should take the market value and calculate the GST, and that market value should be duly certified by a chartered accountant or a cost accountant. And whatever details of reversal that should be furnished in a form ITC 03, 01 availment of ITC on closing stock, 02 transfer of ITC, 02A is also transfer of ITC, 03 reversal of ITC on closing stock. If there is any balance in ITC, that shall be lapsed after reversal. Suppose if there is any shortfall, that shortfall shall be payable, and we need to show this computation separately for CGST, SGST and UTGST, IGST. This is with respect to section 18. Now friends, if you have any doubts with respect to 18, you can ask. Section 18, we discussed 18 subsection 1, 18 subsection 2, 18 subsection 3. Then 18 subsection 4 we don't have, so that is reference to rules. 18 subsection 4 we have, 18 subsection 4, 18 subsection 5 we don't have, but we have 18 subsection 6 that we will discuss. So before discussing 18 subsection 6, fine. Now I am discussing 18 subsection 6. So 18 1, 2, 3, 4 we discussed, 5 is just reference to the rules, and now we are discussing 18 subsection 6. 18 subsection 6 is what? Simple. So whatever is the capital goods, at the time of purchase you availed ITC. So what I am discussing now is section 18 subsection 6. Section 18 subsection 6. You purchase some capital goods. Purchase of capital goods. Purchase of capital goods on which ITC availed. Purchase of capital goods on which ITC is availed. Now these capital goods are disposed of. Now this capital goods is disposed of. Okay. Now what is that we need to do? GST payable equals to A, original ITC availed. So ITC availed minus 5% for every quarter or part thereof. 5% for every quarter or part thereof. From when to when? Part thereof from the date of purchase, not date of availment, from the date of purchase, date of invoice, till the date of reversal, okay. Or B, GST on transaction value, whichever is higher. This is the GST payable. Whichever is higher is the GST payable. This is in case of 18 subsection 6. Now, whenever there is permanent transfer or disposal of business asset on which ITC is availed, so now can we apply this? Yes, but B point will not be there. Why B point will not be there? That is without consideration. So therefore B point will not be there. Only A point will be there. That is so much of the ITC availed minus 5% for every quarter or part thereof from the date of purchase till the date of disposal. Okay, from the till the date of disposal here it is. From the date of purchase till the date of disposal. From the date of purchase till the date of disposal, or GST on transaction value, whichever is higher. This should be taken. And here you please try to understand that here, suppose if transaction value is not there, then only A will be applicable. What if we sell it after 5 years? Because 5% for every quarter or part thereof. 5 years means fully it is over. Then only B, GST on transaction value will be there. Now exception. There is an exception to this. That is in case of A, molds and dies. B, jigs and fixtures. And C, refractory bricks. In this case, that too sold as scrap, okay, then GST payable equal to transaction value into GST rate. Transaction value into GST rate. Why not ITC avail? That A will not be applicable, only B will be applicable. What is that? So in case of 18 subsection 6, I purchased some capital goods on which ITC is availed, now it is disposed of. What if ITC not availed? Then this 18 subsection 6 is not at all applicable. Normal transaction value we will take, on that we will pay GST. Suppose if ITC is availed, then we need to take GST payable equals to so much of the ITC availed minus 5% for every quarter or part thereof from the date of purchase till the date of disposal, or GST on transaction value, whichever is higher. However, in case when the goods are sold without consideration, disposed of without consideration, only A will come. Suppose if the goods are sold after 5 years, only B will come. Also in case when there are 3 goods, that is refractory bricks, molds and dies, jigs and fixtures sold as scrap, then in that case GST payable is only B, that is transaction value into GST rate irrespective of the period when it is sold. So don't apply original ITC minus 5%. This is about 18 subsection 6. So with that 18 is fully over. Now we are moving on to section 19. Section 19 deals with job work provisions. So it's very simple. Section 19 should be analyzed in accordance with section 143. So what is that section 19 says? I am purchasing some capital goods and I am receiving some inputs. Okay. So this purchase of inputs and capital goods is sent to a job worker. And from the job worker's place, the processed goods should be returned within 1 year. And capital goods should be returned within 3 years. Got it? So I am purchasing. I am a principal manufacturer. I will be purchasing some inputs and I will be purchasing some capital goods. So now these inputs will be sent to the job worker and capital goods will be sent to the job worker. Okay. Now in this case, from the job worker's place, the inputs should be processed and the processed goods should be returned within 1 year and the capital goods should be returned within 3 years. This 1 year, what if it is not returned? Maybe it will be extended for a further period of 1 year. 1 year plus 1 year. Capital goods 3 years plus 2 years. It can be extended for a further period of 2 years. If the goods are not returned within that time, it is deemed as supply at the date when it is dispatched to the job worker. After expiry of the time limit, we are deeming it as supply at the time when it is dispatched to the job worker. Is it clear or not? See this. Sent from principal place of business. Okay. And if capital goods and or inputs not received within time, deemed as supply on the date of being sent out by the principal. Suppose if it is sent directly to the job worker's place from our supplier. So that 1 year, 3 years should be counted from the date of receipt by the job worker. And if the goods are not returned within 1 year, 3 years, then it is deemed as supply on the date of receipt by the job worker. Two situations. First situation is we are buying it to our premises and then we are dispatching it. Second is directly the goods are received by the job worker. Okay. Now, ITC not required to be reversed by the principal when goods are sent to the job work. And such goods should be sent under the cover of a delivery challan and e-waybill. Even if goods are directly received by the job worker, ITC can be availed by the principal. Okay, so principal can take. Why? Bill to ship to transaction. Goods are received by the job worker, but billing address can take the credit. So no need to reverse the credit when the goods are sent to the job worker. So these goods are sent to the job worker under the cover of a delivery challan. Okay. Now, additional points. Job worker can avail ITC on the inputs and input services used for job work. For job work, he will be requiring some material na. On that, whatever GST paid can be taken as paid by job work, provided the job worker is a registered job worker. If the processed goods or capital goods are returned by the job worker after 1 year or 3 years, it is treated as new supply by the job worker and chargeable to GST. Okay, so first, from the point of view of principal, we will see not returned within 1 year or 3 years. What principal will do? Principal will treat it as supply to the job worker and pay the GST along with interest. Now, job worker is returning after 1 year or 3 years, treated as new supply to the job worker. So, job worker should pay GST and he will recover the GST from us. But original ITC, whatever we have taken, is gone now because we need to pay GST. Then, the period of 1 year in case of processed goods and 3 years for capital goods can be extended for a further period of 1 year and 2 years respectively. If the job worker is not registered, principal should declare job worker's place as additional place of business of the principal. Okay, this is one important point. Then, jurisdictional officer should be informed about job worker contract and the principal should declare what are the goods sent to the job worker and received from the job worker in a form called as ITC 4. ITC 1 availment of ITC on closing stock, ITC 2 transfer of ITC, even 2A also, ITC 3 reversal of ITC on closing stock, ITC 4 is goods sent and received from the job work, ITC 4 is to be filed on a quarterly basis by 25th of the month following every quarter. Okay. Then, sir, processed goods are there in job worker's place. Either that can be brought back to principal's place or it can be exported or sold from that place itself. Okay. So, this is about section 19 here. Now, friends, if you have one more point is there in section 19. So, in section 19, that is in case of tools, molds and dies, jigs and fixtures, not refractory bricks. Tools, molds and dies, jigs and fixtures, there is no condition to bring it back within 3 years. Capital goods, these are capital goods. There is no condition to bring it back within 3 years. Even if you are not bringing back, it is okay. What are those 3 goods here? Tools, molds and dies, jigs and fixtures. There is no condition to bring it back within 3 years. The 3 years point is not applicable. So, here only area where you will get confused is that, so whenever the goods are sent and not received within 1 year or 3 years, from principal point of view, what he need to do? He need to treat it as supply at the time when the goods are sent to the job worker. Now he need to pay GST along with interest. Done. Now what job worker should do? Job worker, when he returns it after 1 year or 3 years, he should treat it as a new supply. That's it. Okay. With this, section 19 is over. If you have any doubts on section 19, you can ask. If you have any doubts on section 19, you can ask. So, the last area that is pending is section 20 and 21. Reversal of ITC on closing stock, invoice must be in hand. Need not be. If invoice is not there, we will take the market value. Okay. Any doubts related to section 19? Can I proceed? Job worker expenses can be claimed as ITC from principal view. Yes. Job worker will be charging job charges. On that job charges, GST paid by the job worker will be recovered from the principal and principal can take ITC of that. Yes, possible. That's normal. Okay. So, if you have any queries, you just post it there. Meanwhile, I'll complete section 20 and 21. I'll come back to your queries and I will clarify your queries. Okay. So, section 16 we completed, which is dealing with conditions for availment of ITC. Section 17, apportionment of credit and blocked credit. Section 18, input tax credit in special cases. Section 19, goods sent on job work. Now, section 20 and 21 is related to input service distributor. So, input service distributor is a head office. Say here, there is a head office and there are some divisions. There is a head office. There is a head office or there is a corporate office. There is a head office or there is a corporate office or there is an admin office, administrative office, and there are some branches or divisions. There are some branches or divisions. Now what will happen? So there is a person who raises invoice to the head office. So, receipt tax invoices for input services, only input services, not inputs, because they are input service distributor, only with respect to input services. So, tax invoice they got, so they can take it as credit. With respect to these tax invoices, with respect to this tax invoices, ITC availed. ITC availed by whom? ITC is availed by the head office or corporate office or admin office. And they will distribute that ITC to the branches. They will distribute the ITC by giving ISD invoice. In what ratio? In what ratio? In the ratio of turnover. In the ratio of turnover, the credit will be distributed. Now, the person, that head office, corporate office or administrative office will be known as input service distributor, and they need to get a separate registration. So, ISD should get a separate registration, and these branches or divisions are under the same permanent account number. Now, here sir, I have a doubt. That is, if the head office is in Tamil Nadu, branch is also in Tamil Nadu, not an issue. CGST will be distributed as CGST, SGST will be distributed as SGST, IGST will be distributed as IGST. But when the branch is in, say, Andhra Pradesh, head office is in Tamil Nadu, how the credit will be distributed? CGST, SGST, IGST, all three will be converted as IGST and will be distributed as IGST. Got it? So, CGST credit and SGST credit is distributed as what credit? IGST credit. So, the person in Andhra Pradesh, the branch in Andhra Pradesh will be taking it as IGST credit. That is this point, please see. CGST and SGST distribute as CGST, SGST for unit in the same state and distribute as IGST if unit is in a different state than that of ISD. Then, some special points in this regard. Suppose if the input service is consumed only by one unit, but invoice is raised to the ISD. Now, entire credit will be distributed to that unit only. Suppose if input service is consumed by two or more units, then the credit will be distributed to those two or more units only in the turnover ratio. If that is common to all units, not just specific to one or two units, then in that case, the credit will be distributed to all the units which are operational during that month. So, based on the turnover ratio, okay. Now, what should be taken as the turnover? So, either you take the turnover of the previous financial year, or if the turnover of the previous financial year is not available, take the last quarter turnover, okay, based on the availability. Then, whether the credit needs to be distributed by ISD on a monthly basis or quarterly basis, monthly basis, and they need to file a return. What is that return? GSTR 6 by 13th of the month following every month. Suppose if they distribute any excess credit, that excess credit distributed can be recovered by issuing a ISD credit note. For example, 3 branches. So, to 3 branches, 10,000, 10,000, 10,000 is distributed. But what is to be distributed is 12,000 and 12,000, 12,000, 12,000, 12,000, 6,000 should be distributed. But instead 10, 10, 10 is distributed. Now, in that case, so to 2 branches excess distributed, for that 2,000 rupees, 2,000 rupees, ISD will give a ISD credit note. ISD credit note to one branch where shortfall is there, they will give a ISD invoice. If they are not doing it, and department comes to know, section 21, they will recover it from the 2 branches, 2,000, 2,000, and they will not give the benefit to the 3rd branch, okay. So, department will recover it as tax dues from the 2 branches, excess distributed credit along with interest. Shortfall in distribution can be distributed using ISD invoice. Distributed credit should not exceed the credit available for distribution. For example, 1 lakh credit I have means 1 lakh only I should distribute. If the ISD has distributed excess credit, this is what section 21 says, to any recipient, the excess can be recovered from the recipient with interest. This is given where? In section 21. And ISD should get a compulsory registration irrespective of the aggregate turnover. Now, say for example, MRF Limited is having a corporate office in Tamil Nadu, factory in Tamil Nadu, Andhra Pradesh and Karnataka. So, now in these 3 states, 3 registration, plus for the corporate office they should get a 4th registration even though they have a registration in Tamil Nadu. So, ISD should get a separate registration, okay. So, with this we completed all the important points related to input tax credit. So therefore section 16 to section 21 we have completed.